There's a business you've never once thought about. It takes wrecked cars, flooded cars, cars your insurance company already wrote off as garbage, and turns them into one of the highest margin businesses in America. It doesn't build anything. It doesn't manufacture anything. It doesn't even own what it sells. It just stands in the middle, takes a fee from both sides every single time, and lets accidents do the rest. By the end of this video, you will never look at a wrecked car on the highway the same way again. So you want to own a car auction house? Buy some land, put up a fence, tow in the wrecks, auction them off. Sounds simple? It's not. Almost everyone gets this business completely wrong. And the part they get wrong is the exact part that makes all the money. First, two different businesses hide under the same name. Wholesale auctions move used but working cars between dealers. Trade-ins, off-lease returns. Salvage auctions move total loss wrecks from insurance companies to buyers. Two companies control almost all of the salvage side. A duopoly. Nobody has broken it in 30 years. That's the whole story right there. Here's the term the entire industry runs on. Total loss. Get in an accident. And if the repair cost crosses somewhere between 70 and 80% of the car's value, your insurer doesn't fix it? They total it. They pay you out. They take the wreck. And now they're holding a busted asset they don't want, can't store, and don't know how to sell. That wreck has to disappear fast for as much money as possible. That disappearance is the entire product, not the car. The disappearance. Now the scale. One company alone processes around 4 million vehicles a year, 250 plus locations, 11 countries, a million registered buyers across 185 countries. And here's the number that should stop you. Total loss frequency just hit an all-time high, over 22%. 1 in 5 accident claims doesn't get repaired anymore. It gets shipped to a yard like this. That number has been climbing for years, for a very specific, very modern reason, and we'll get to it. The founding story tells you everything. 1982, a single salvage yard in California. Founder still chairs the board today. 40 plus years later, for 2 decades the whole industry ran the way it had since the 1950s. Live auctions. Auctioneers in a gravel lot. Buyers standing there in person. Whoever showed up that Tuesday then, one decision changed everything. Kill the live auctions. Move it all online. Everyone said it was too early.com 20 years later. We know exactly how right that bet was. Here's why it mattered so much. A live auction is limited by geography. Your buyer pool is whoever can physically drive there. An online auction has no geography at all. The same wrecked sedan sitting in a Texas yard gets bid on at the same time by a dismantler in Ohio, an exporter in Poland, and a used car dealer in Nigeria. More bidders means higher final prices. Higher prices means insurers keep sending their volume here instead of a competitor. More volume means more buyers show up next week, because that's where the inventory is. That's the flywheel. Liquidity attracts liquidity. People who study this business seriously will tell you a salvage auction and a stock exchange share more in common than you'd expect. Now the moat. Underneath the moat, land. This business needs hundreds of acres per yard, positioned close enough to major cities that tow trucks stay cheap and fast. That land has to be zoned specifically for vehicle storage and dismantling, and most cities do not hand that zoning out freely anymore. For the obvious environmental reasons, a new competitor doesn't just need money, they need hundreds of acres, permitted, in dozens of metro markets all at once, competing against a company that already bought and owns the best located parcels from decades ago. So here's the single number that matters most in this entire video. 85% of revenue is fees, not vehicle sales fees, auction commissions, storage charges, towing coordination, title processing, professional imaging. The company barely ever owns the car at all. The insurer owns it right up until a buyer pays. No inventory risk. No guessing what a wreck is worth and holding it on your own balance sheet. Just a fee from the seller. And a fee from the buyer. On every single transaction. Whichever way the price moves that day, sit with that for a second. Paid by both sides. Never owns the inventory. Gross margin runs around 45%. Operating margin, high 30s historically, though it's compressed recently, more on that shortly. On a business that is physically mostly land, a fleet of tow trucks, and a website. That margin profile does not exist anywhere else in physical logistics. It exists here specifically because the company never finances the thing it's selling. Let's actually walk through one single transaction, because the mechanics matter. Say a sedan gets totaled. Insurers pay out to the policyholder $11,000. The wreck itself sells at auction for $2,200. The winning bidder pays that $2,200 plus a buyer fee, typically running somewhere between $200 and $400. dollars, depending on the sale price tier. The insurance company, the seller, also pays a fee out of their side, usually another $1 to $200, for towing, storage, and the auction service itself. Added up, the auction operator just made $300 to $600 in pure fee revenue on a car worth barely $2,000 without ever putting a single dollar of their own capital into owning it. Multiply that by 4 million vehicles a year, and you start to see why this is one of the best businesses nobody talks about. Even at a conservative average of $400 in combined fees per vehicle, that is over $1.5 billion in pure fee income. Before counting a single dollar from the roughly 15% of revenue that comes from vehicles the company occasionally buys and resales on its own account. Who's actually bidding on these wrecks? Dismantlers stripping usable parts for the repair market? Engines, doors, transmissions, rebuilders, licensed to fix the car and resell it on a salvage or rebuilt title, usually at a steep discount to a clean title equivalent. And increasingly, exporters, shipping containers of damaged American vehicles to countries where skilled repair labor is dramatically cheaper, making it worth fully rebuilding a car that would never be worth fixing here. That labor arbitrage is the fastest growing slice of the buyer base. And almost nobody outside this industry knows it exists at this scale. Why does total loss frequency keep climbing year after year? Not because accidents got worse, because cars got expensive to fix. A bumper today has radar sensors behind it, cameras, parking sensors. All of it needs recalibration after even a minor hit. Electric vehicle battery packs make repair costs worse still, sometimes dramatically so. Every one of these pushes more claims. Over that 70 to 80% threshold, this is a structural, multi-year tailwind, and it has nothing to do with how many accidents happen and everything to do with how expensive modern cars became to repair. Weather is the single biggest swing factor in this entire industry, and it flips the usual disaster script on its head. A major hurricane floods a metro area, and tens of thousands of vehicles get totaled within weeks. Hurricane Harvey, 2017, is still the reference case the whole industry points back to. For almost every other business, a disaster is bad news. For this one, more flooded cars means more total losses, means more auction volume, means more fee revenue. It's an uncomfortable thing to say out loud on camera. It's also just true, and every operator in this space will admit it privately. Balance sheet, low debt, billions in cash, expansion funded from the company's own operating cash flow, not borrowed money. That matters specifically because nobody can predict. When a hurricane hands you 10,000 extra cars next month, if you needed a bank loan every single time volume spiked, you'd be one bad financing cycle away from being unable to handle your own catastrophe surge. Keep the balance sheet clean, and you can buy land and absorb a spike the moment it hits. No permission needed from a lender. Let's talk about what a catastrophe surge actually looks like on the ground, because the number is genuinely hard to picture. A single major hurricane can flood tens of thousands of vehicles in one metro area in under a week. Every one of those cars needs a tow truck, a storage slot, a photographer, and a title clerk, all within days, not months. Because insurers are under regulatory pressure to settle claims fast. And a wreck sitting uninspected in a lot for 6 weeks is a liability nobody wants. Yards that normally process a few hundred vehicles a week suddenly need to process a few thousand. That's why land banking, buying more acreage than you currently need, sitting mostly empty in a normal year, is not wasteful. It's the insurance policy against exactly this scenario. International growth is where the next decade of this story gets written. The UK, since 2007, now a genuinely dominant position. Germany, Spain, the Middle East, still early innings. Still building the buyer liquidity that took decades in the US. Brazil gets mentioned constantly as the single biggest long-term prize. One of the largest auto insurance markets in Latin America. And the salvage infrastructure there is still fragmented and underdeveloped. That is exactly the kind of gap this company has, a habit of eventually filling. Now the costs, because even a fee-only marketplace has real bills. Land, the biggest and most permanent one. Hundreds of acres per yard in markets where industrial land is neither cheap nor easy to zone. Towing a fleet that has to scale up fast during a catastrophe without staying permanently overstaffed the rest of the year. Imaging and title processing, every single car photographed, damaged, and pushed through paperwork that is different in every state and every country, meaning compliance. Expertise across dozens of separate legal systems, running simultaneously. Insurance on the yards themselves is non-negotiable. Given you're storing damaged, vehicles with fluids and batteries, sitting outdoors for weeks at a stretch. And technology, real-time multi-language bidding. Anti-sniping protection? Increasingly AI-powered damage. Assessment that estimates a car's likely sale value the second it rolls through the gate. That is a continuous, genuinely expensive software investment. The same way a stock exchange has to keep investing in its matching engine just to stay competitive quick. Detour back to the wholesale side because the comparison is genuinely useful. A dealer-to-dealer wholesale auction, moving clean, working off lease cars between dealerships, looked similar on the surface. An auctioneer. A lot full of cars, a gavel, but it's a completely different risk profile. The cars are drivable, the titles are clean, and the buyers are almost entirely licensed dealers. Not international exporters or backyard rebuilders. Margins are thinner there because the product is closer to a commodity. A working Camry is a working Camry. The salvage side makes more, per transaction specifically because every single car is a unique damage assessment problem. And that complexity is exactly what the fee is paying for. Title law is its own hidden cost center, and it's more fragmented than almost anyone expects. Some states brand a salvage title for life, permanently marking the car's history. Others allow it to be upgraded to a rebuilt title after a state inspection confirms the repair was done properly. Export markets have their own separate rules, entirely about what documentation has to travel with the car across a border. None of this is standardized. None of it is optional. And a company operating in a dozen countries is effectively running a dozen different compliance departments at once just to keep the paperwork legal. The duopoly itself just got tighter. The other major salvage player merged with a much larger equipment auction company in 2023, folding the second biggest name in American salvage into an even bigger, publicly traded parent. That's consolidation happening at the very top of an already concentrated industry. And it makes the land and relate moat we just talked about even harder for anyone new to crack. Because now there are effectively two enormous, well-capitalized incumbents instead of a leader and a scrappier challenger. Staffing is its own quiet cost center nobody puts in the highlight reel. Every yard needs tow truck drivers, forklift operators moving wrecks into storage rows, professional photographers documenting every angle of every vehicle for the online listing, title clerks buried in state-specific paperwork, and yard managers coordinating all of it across sometimes hundreds of acres of gravel and steel. None of these are especially high-paying roles individually, but multiply the headcount across 250-plus locations, and it becomes one of the largest recurring line items on the entire income statement, right behind land and insurance. One more mechanic worth understanding: flexible sale formats. Traditional auctions only sell at whatever the highest bid happens to be on sale day. Period. Modern platforms increasingly offer sellers a buy it now option, a fixed price a buyer can accept instantly without waiting for the auction clock, and a make an offer option, letting a buyer propose a price the seller can accept, reject, or counter. Both tools exist to solve the exact same problem: getting a wreck sold and off the insurer's books faster, because speed of disposal is, remember, the entire product being sold here, not just the final price achieved. Here's the uncomfortable part, and it's the part most people never see coming: 250 plus owned. Yards do not get cheaper to run just because volume has a slow quarter. Recently, a decade of roughly 15% annual growth stalled out almost completely. One quarter actually contracted outright. Operating margins slid from the high 30s down into the mid-30s. Fixed costs simply do not flex downward. We've seen this exact pattern in every capital-heavy business in this series. Stadiums, cruise ships, wind tunnels, same problem, wearing a different outfit each time, and the stock market does not forgive. That kind of slowed down gently. This company went public in 1994, split its stock multiple times since, delivered roughly 5 times your money over the past decade. And over just the last 12 months, as growth fell from double digits into low single digits, the stock dropped by more than a third, badly lagging its own long-term track record. The lesson here is important. The market was pricing in the growth rate, not just the current level of profit. The moment that growth rate breaks, even a dominant debt-free, high-margin business gets repriced hard, almost overnight. Let's talk about what your actual take-home would look like running one of these yards at a regional level, because the range is wider than people assume. A well-run, well-located regional operation, strong insurer relationships, healthy buyer turnout, can put an owner-operator's annual take-home somewhere in the $60,000 range in a rough year. Weak weather, soft used car pricing, competitive fee pressure. In a strong year, hurricane season active, totally lost frequency climbing. That same operation can push an owner's take-home toward the $100,000 range and beyond. Same yard, same land, same fixed costs. The swing between those two numbers is almost entirely about volume and weather, not about anything the owner did differently. What could actually kill this business long-term. If repair costs ever came down meaningfully, cheaper sensor parts, standardized recalibration, fewer cars would ever cross the total loss threshold in the first place, and the entire supply pool shrinks at the source. Electric vehicles cut both ways here. Expensive battery pack repairs push more EVs into total loss territory today. But that could reverse as the technology matures and repair networks standardize, and a well-funded new entrant could, in theory, try to break the except the land acquisition timeline alone. Buying and permitting hundreds of acres across dozens of cities means any serious challenger is a decade away from even competing on buyer liquidity, let alone winning it. Optimistic case. Total loss frequency keeps climbing as cars keep getting pricier to fix. A couple of active hurricane seasons push volume to fresh records. International buyer participation keeps deepening, and the company converts all of that into fee revenue on a yard network. It already finished building years ago, with almost no incremental capital required. Revenue and margin expand together. Cash keeps piling up on a balance sheet carrying almost no debt. The flywheel keeps reinforcing itself. Quarter after quarter, realistic case. Growth slows because the core domestic market has genuinely matured. A mild winter means fewer weather-driven claims. Repair cost, inflation cools. As parts supply chains finally catch up with modern vehicle complexity, the fixed costs across 250-plus owned yards do not shrink to match the slower volume. Margin compresses a few points. The stock, which had been priced for perpetual double-digit growth, gets slashed hard even though the underlying business is still highly profitable. Still debt-free. Still sitting in the exact same competitive position it held a year earlier. The business didn't break. The growth rate did. In public markets, for a company like this, those two things get treated as almost the same event. Let's put a real number on all of this. Because percentages and margins only mean something once you see the actual scale. The dominant player in this industry pulled in well over $4.5 billion in revenue. In its most recent full fiscal year, a record year on operating cash flow north of $1 billion in just 9 months. That's not a niche business anymore. That's a company most retail investors have never once thought about. Generating more annual revenue than plenty of household name retail chains, entirely from fees on cars nobody wanted in the first place. And the stock has traded on a major exchange since 1994. Under a ticker most people couldn't name if you asked them. Run for the last several years by a CEO who joined as chief financial officer nearly a decade earlier and worked his way up. Not an outside hire brought in to shake things up. That kind of multi-decade continuity at the top. No dramatic pivots, no reinvention, is exactly the pattern. You want to see in a business whose entire moat is built on relationships and land that took 30 years to accumulate. The smartest operators in this industry figured this out decades before anyone else even noticed. The goal was never to run a junkyard. The goal was to become the marketplace, and more specifically, to embed so deeply into an insurer's own claims workflow, the towing dispatch, the storage, the photography, the title paperwork, that switching to a competitor would mean re-engineering the insurer's entire internal process. Not just picking a different auction website. That is not a patent. That is not a brand. That is an operational dependency. Built one insurer relationship at a time over 30 straight years. Sitting on top of physical land that nobody else can simply go by next Tuesday. So if you do decide to build a car auction house, here's what you actually need to understand. You are not buying a junkyard. You are buying a two-sided marketplace bolted onto an enormous, hard-to-replicate footprint of industrially zoned land, collecting fees from both the seller and the buyer on every single transaction, without ever carrying the risk of owning the inventory yourself. Get the land, the buyer liquidity, and the insurer relationships right. And you own one of the highest, quietest businesses in the entire American economy, one that gets paid more, not less. When the world has a genuinely bad year, get the growth story wrong, or simply let it mature. And the market will reprice you overnight. Even when nothing about the underlying business actually broke. The wrecked cars stacked in the yard, that's just the raw material. The real business is the auction. Almost nobody outside this industry ever thinks to watch. If this changed how you'll look at a wrecked car on the side of the highway, subscribe. We break down a hidden, overlooked business exactly like this one every single week. And here's my question for you. If you had the capital to build one of these from scratch, would you go oolin on land in a handful of major cities, or spread thinner across a lot more locations? Comment your answer below. I genuinely read every single one. Take care. See you in the next video.